All right. Well, okay, we've got a new section we're going to do on the Gray Report. This has never been done before. First time if you're listening. You're one of the first people ever to listen to this. So it's a new piece, and we're going to work on the name. But right now, it's the multifamily jargon bin. We're taking terms, multifamily terms, and phrases that you may know, you may not be familiar with, and we're breaking them down. Our audience on the Gray Report tends to be more sophisticated. We kind of put them in the kind of the intermediate to advanced. We don't have a lot of like first time investors, but we do have some, and we do want to be able to provide content that resonates with the very advanced investors as well as the I'm just exploring this for the first time. So breaking these terms down that to us in the industry we use as shorthand day in and day out. But what we've got folks I know in our office still that probably aren't fully familiar with some of these terms, what these terms mean. And so we want to break them down in three different ways. One, as simple as possible, fifth grade understanding. Second, relatively novice investor. I know about investing, but just kind of in the simplest terms that it has a little bit more context. And then kind of in the third method of, true, nuanced, experienced investor, how do we at Great Capital think about this term and just going a little bit deep. So the first term, it's the one that everybody talks about. And it also has, I think, the most questions, and it's probably the term that most people, there's a lot of people who, don't know what the term means, or they kind of do, and they're just like, yeah. And that's, they just kind of, nod their head, and like, I kind of know what it means. And that is cap rate, the capitalization rate. We talk about it all the time. We hear people say, is that a good cap rate, or what's a good cap rate, or where are the cap rates? And all of those questions can be difficult to answer because, a cap rate can mean different things to different people. So let's break it down. Any questions about cap rate, Griffin?
No, I'm excited to talk about it. Excited.
So from the easiest definition that I could come up with is a cap rate is a simple way to understand, right? Mm-hmm. How much money a building makes compared to how much it costs. So how much cash flow does a building put off or to distribute relative to what it costs. So if you have a $1 million building and it's making $50,000 worth of cash a year, that's a 5% cap rate. If it was making $100,000 a year and it costs you $1 million to buy that building, that would be a 10% cap rate. Mm-hmm. So you can see the higher the cap rate goes means there's more kind of cash flow that's being put, that property is distributing, is putting off. So if you think about it as if I buy this building, how much money does it earn each year for every dollar I paid? Mm-hmm. Okay. So now going to a little bit more nuanced, a little bit more advanced, it's, so the way we calculate cap rate is we take our net operating income divided by the value mm-hmm. of the property. That provides us our cap rate, okay? So we also know that if we take our the value of the property times the cap rate, we're going to be able to determine what our net operating income is. Mm-hmm. So we can use it a variety of different ways, whether we only need to know 2 out of 3 variables to be able to determine what that third variable is. So by knowing a little bit about a property, again, if I know how much net operating income or NOI it's producing, and if I know kind of the cap rate that properties are trading for in the area, I can estimate the value, the market value of that property.
Right.
The challenge is, what is a good cap rate? There is no going cap rate in a market. Mm-hmm. It's relative to what the market believes the risk is for that asset, for the asset class, and that given property itself. The lower the cap rate is, so a lower cap rate means that the price is actually more expensive. So a property that has a low cap rate will have a higher price than that same property. If it had a higher cap rate, that means that price is going to be lower mm-hmm. because the price that you have to pay relative to that income. So again, let's look at that, the $100,000 income off the $1 million property. If I'm willing to pay $2 million for that property, all of a sudden that goes to, instead of a 10% cap rate for the $1 million property, $100,000 distribution, if I paid $2 million for it, it would be a 5% cap rate. So if I'm in a bidding war, you and I are trying to buy this property, you want to pay $1 million, I want to pay $2 million. Obviously, I'm paying up. I'm paying the higher price. I'm buying it at that lower cap rate. So lower cap rate, higher price. Higher cap rate, lower price. So then the next level of how, I think more, call it sophisticated investors, is that cap rate comprises a lot of information. It tells you about risk. It tells you about the type of market. It can tell you about liquidity. It can also tell you about future earnings. So a cap rate may be low, for example, on a value add deal, which means it's expensive relative to the cash flow that it produces. The reason that might be expensive and the cap rate may be lower, even though individuals might say, hey, that's an older building. Like, what do you mean it's going to go for a lower cap rate? But if it's in a market that has a big opportunity to increase the rents, an investor might come in and speculate, well, I can increase rents at this property $200, $300. And so my in-place cap rate, which might be relatively low, in-place cap rate is the actual cash that the property is producing today. That might be low. But my stabilized cap rate, which is the cap rate after I've bought the property, after I've raised the rents, and I've stabilized the revenue and the net operating income, that stabilized cap rate may be much higher because I've purchased the property, but I've increased the income and the cash flow from the asset itself. So that cap rate has moved from call that low 5%. Now I'm operating at an in-place cap rate of 6, 7%. People confuse cap rate with return. Cap rate is not really your rate of return. You can think about it as an unlevered return, and it's a proxy for that. But the reality is no one just pays $1 million for the property. If the purchase price is $1 million, that's not all the money you have to pay. You typically have to bring money to the table for some renovations. You have fees that you have to pay. You have financing costs. And so, you think you're bringing $1 million, it's actually, maybe it's 1.2, 1.3. And so, yield on cost, which is the total cost of the total capitalization cost, all of the dollars that go in to that property, you divide that by your actual income that's distributed. And that's your true yield on cost, the yield of what it costs me to actually buy it, which is different from the cap rate, which is derived from your purchase price or your value. The reason why we do that, though, is to keep things relative, and you can compare property to property, market to market.
Right. Taking the LP lens, I want to meet you somewhere in the middle, at our middle level of sophistication, understanding of a cap rate. You're an LP thinking about making a private placement, really just across commercial real estate, but for today's purposes, Midwest multifamily asset class.
Yeah.
You see a cap rate come across the table from a sponsor that's offering you a deal. Let's say it's a 5% cap rate. As an LP, when you see that 5% cap rate, because the cap rate is a great tool to evaluate a deal rather quickly. There's other nuances and variables that should likely be considered, but if we're focused specifically on that 5% cap rate, what does that tell you about the project before you even turn the page to look at any of the other details?
Well, I'd first say I would never just look at a cap rate in isolation, and I would ask, okay, what 5% cap rate, is that stabilized? Is that in place? Because in place 5% cap rate, that seems relatively low, but it could make sense relative to the business plan. Because again, if that in place cap rate, that represents, if it's based on their trailing 12 months financials, I'm evaluating, the income from the prior owner, which has a lot to do with the future cash flows. But if I have a business plan to do something different from the previous owner, I'm not going to make the decision to invest solely based upon that in-place cap rate. I want to know what the business plan is to get to, whatever stabilized cap rate or stabilized yield, and evaluate how feasible I think that business plan is to get to that point of stabilization. And so, but if I hear 5%, 5% cap rate, again, I'd have some questions on, is it based on, are we talking about an in-place cap rate? Is it based on T12, financials? So I know that I'm actually comparing cap rates of what I think a cap rate is to what you're telling me. Because what you'll hear a lot, whether that's through brokers or syndicators, they'll give you the stabilized cap rate. It's like, we're buying it, it's going to be a 7%. It's a 7% stabilized cap rate. It's like, well, that's great, but if you can't execute your business plan, you don't get 7% ever. You get the 5, the 4, whatever you actually bought the in-place cap rate at. Brokers and others will also they'll play around with the time periods for the financials. So they'll say, this is the the trailing 3-month income, but but the trailing 12-month expenses.
Right.
So basically, it's like they had a really good 3 months. Forget the other 9 months of the year. Yeah. We'll take their annual expenses because expenses can be weird. There's weird seasonal behavior that goes on on the expense side. Same thing with revenue. But so they'll take basically, hey, we have a great 3 months. We're going to value it on the last 3 months, which that takes a sophisticated investor to understand, that the last 3 months are indicative of the trajectory of the asset of the property, or were they just, giving out concessions, crazy marketing spend in the last 3 months were an anomaly, and you're really paying a what seems to be attractive cap rate. They're saying that it's on the trailing 3 month income T12 expenses, it's a 5.5, it's a 6. But then you use that 12-month income cap rate, and all of a sudden it's a 5, or if it's a 4. And sometimes they do that because let's say the property had a problem 11 months ago. There was a car, drove off the road and crashed into, something that had nothing to do with the property, really. Right. Oh, that was next to a road. And the property had spike in vacancy because of that, for whatever reason. People had to move out. And so we went down to 85%. Well, so you'd want to exclude that month because, that's not going to happen every year. Let's exclude that. Let's just use, an annualized period of the last 6 months or 3 months. Maybe that's appropriate. Or it was in lease up. Let's say the property was only 50% leased up 11 months ago, but it's been leased up for the last 6 months. Well, yeah, it probably makes sense to use the last 6 months versus the last year because you're not in lease up anymore. Right. So there is a lot of nuance, and it's okay to ask. Okay, what is that cap rate based on? What kind of cap rate are we talking about? Again, is it stabilized? Is it in place? If it's in place, we're talking 3 months, 1 month, 12 months. And so you can see how all these numbers can be manipulated. But by being knowledgeable about the differences in cap rates, different ways to look at them, you can at least arm yourself to ask the right questions.
Right. Makes a lot of sense. The cap rate conversation can get a little bit muddy because it can get very complex. It will be a good opportunity to maybe dive into this conversation maybe in the next podcast or weeks down the line of just, what truly influences a cap rate. And I know that we use cap rates on acquisition, but we also project, cap rates at disposition. So be interested to kind of dive into what makes up some of those exit assumptions to calculate, an ideal exit cap, and then maybe how we're using or differentiating our entry cap from our exit cap, and how those calculations are getting made. There's an audience for that. I'm not sure that they're, specifically watching the GRR report, but would be an interesting conversation.
Know. Everyone might just be sitting around and be like, let's talk about cap rates all day. No, we've talked about them too much. But but let us know in the comments if you want us to talk about more about cap rates. We can go into even more detail. Because, again, like Griffin, you were saying, there are so many tools you can use cap rates for. Like for evaluating, the ROI on, renovation or, the true value of expenses, because the cap rate is essentially a way to put a multiplier on the money that is going in or out of a property.
Right.
And so, again, like you can say, well, that expense, that's going to cost us, $20,000 of recurring revenue. Okay, well, maybe $20,000 doesn't seem like that much, but if you put a cap rate underneath it and all of a sudden it's, hundreds of thousands of dollars or, $1 million of value that's missing from NOI. When you go to sell it and someone puts a cap rate under your NOI, again, that's the value that they're going to extract. Mm-hmm. So again, $10,000 of more revenue or $10,000 of more or less expenses, that all, put a multiple on that. And so it really shows you how important, the the kind of the nickels and dimes and how important every single lease is at a property when it comes to actually valuing it and selling it at the end of the day, which is also how we can force appreciation. Why multifamily and commercial real estate is great because the properties are valued based on cap rates, based upon income. So if we can add income or get NOI up by reducing expenses, there's almost a 20x multiplier that's tacked on to that savings, or value,
Right.
revenue increase. Yeah, it's exciting stuff.
The cap rate being a snapshot of a moment in time with past historical financials and future growth kind of baked in. It does kind of get to be somewhat of a guessing game, and I would be interested in furthering the conversation of how does Gray Capital go about figuring out which cap rate is palatable, which cap rate is simply not palatable. What factors of the cap rate conversation and the equation are we really taking into maybe larger impacts into our acquisitions? A lot to kind of contemplate, a lot to bake in. You can tweak the cap rate on exit and create some very serious value, very impactful value. But you can also kind of tweak the cap rate going in, just based off of how much you're willing to pay for a project. So it's an interesting conversation of this ever movable, slider of where the cap rate may sit and how it can truly impact an investment moving forward.
Yeah, it is interesting. It's something that we use a lot, but with variable weight, I guess, that we put on it. I mean, we use it again as a tool to compare. Like we're looking at a project. Just the first couple of glances, and a question we might ask. What is the cap rate of it? What are they at? What are they asking? They're asking for $50 million. Okay, what is that? What cap rate is that?
Right.
And then it's like, well, it's a 5 cap. It's like, well, okay, well, what is that it's cap rate on T12? What? And it's cap rate on T12. Okay, 5%. That seems low. It kind of seems where market is. But then you look at it, like, for example, a property that has a 5% cap rate but has no ability to grow rent versus a property at a 5% cap rate that's in a market or the opportunity to grow rent significantly, high rent growth. Well, those are two completely different prospects because, one, you're going to be stuck at a 5% yield or less for foreseeable future. The other, you're going to grow out of it. You're going to move to that stabilized number. And so again, it's the deal, it's the market, it's the operator, and it's the business plan that all have to come together for you to make a decision. But a cap rate can be a really good tool in a way for us all to communicate about kind of that the cost relative to existing yield.
Right.
Yeah. So fun
Excellent
stuff.